Finding stocks that offer investors high dividends and an impressive amount of growth is definitely not an easy task. When it comes to dividend-paying investments, you often get two choices. Either a stock like Procter Gamble that offers a lower dividend yield but has some growth behind it, or a stock like Ares Capital that offers a really high dividend yield but over the long term doesn't have too much growth in terms of its share price. And while most stocks are somewhere in between this, you usually don't see a ton of high growth, high yielding dividend stocks out there. However, the stock we're going to be taking a look at today has seen some of the most impressive growth out of any high-yielding dividend stock out there that I've come across. As of the making of this video, this stock is up over 50% from a year ago, up 175% from 5 years ago, and it's up an impressive 461% in the last 10 years. On top of that, this stock has increased its dividend distributions pretty significantly over the years, with the company being able to grow their dividends for 9 consecutive years. Oftentimes, they've been able to grow it every single quarter. The company I'm talking about is Arbor Realty Trust, ticker symbol ABR. They invest in a diversified portfolio of structured finance assets in the multifamily, single-family rental, and commercial real estate markets in the United States. The company operates in two different segments, structured business and agency business. It primarily invests in real estate-related bridge and mezzanine loans, including junior participating interests and first mortgages, and preferred and direct equity, as well as real estate-related joint ventures, real estate-related notes, and various mortgage-related securities. Currently offering a dividend yield of 7.34%, Arbor Realty's dividend history is extremely impressive. As I just mentioned, they've been able to increase their dividends almost every quarter for the last 6 years. Right now it pays investors 36 cents per share per quarter, and according to Seeking Alpha, ABR has a payout ratio of 69.83%, which for a real estate investment trust is pretty good. It's actually a lot better than some of the other larger REITs out there like Entail Capital. If we use a dividend reinvestment calculator to determine the overall return of a $10,000 investment into Arbor Realty with dripping, if you would have invested in ABR 10 years ago, you'd be looking at a total return of 1,044.15%. Your original $10,000 would now be $114,434.50. This is some of the best growth out of any high-yielding dividend stock I've ever come across. If we compare that with the S&P 500, we can see that Arbor Realty has just completely blown them out of the water. As you can see, ABR has outperformed SPY, which is an index fund that mirrors the S&P 500, by nearly 700% in the last 10 years. So far we've seen that Arbor Realty has just been killing it in terms of performance. But now we need to ask the most important question about this stock, and that is, what does their future outlook entail? After all, past performance never guarantees future performance, so just because a stock has continued to do well and go up doesn't mean that it'll continue to do so in the future. What exactly is Arbor Realty and how do they make money? Let's take a closer look into this company and try to determine what the future holds for them. First of all, we can see that Arbor Realty is structured as a mortgage REIT, which is a company that provides financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities and earning income from the interest on these investments. For those of you who might not have seen too many of my videos, I'm typically not the biggest fan of MREITs. The reason being that so many of them have a history of decreasing their dividends as time goes on. To just point out a couple of examples, AG&C Investment Corporation is one MREIT that's continued to decrease their dividends over the years. Arbor Realty is another mortgage REIT that's continued to decrease their dividend amounts over the years as well. Even the largest and probably the most well-known mortgage REIT out there, Entail Capital, has continued to slowly provide investors with less dividends over time. But there are some mortgage REITs out there that I'm a fan of that I've talked about a couple times on my channel before. For example, Ares Commercial Real Estate is one in particular that I really like. I like the management company behind them, who also own Ares Capital, which is my favorite BDC of all time. They've continued to show just how exceptionally well they are at managing their companies. New Residential is another mortgage REIT that I think after the plunge of 2020 is a company that has some potential amount of upside to it given the company's latest developments. But for the most part, I just haven't been a big fan of mortgage REITs. So what makes Arbor Realty different in terms of how they've been able to grow their share price and their dividends pretty significantly? Let's take a look at their investment portfolio. I thought it was kind of strange that if we go to their website, it really doesn't provide too much information about their portfolio. They have this small little fact sheet that breaks down their investment industries and their geographical locations, but as far as what kinds of loans make up their portfolio, I'm just not finding too much on their website. In this situation, we're going to have to take a deeper look by going into the company's financials on the SEC's website. For a REIT, the best financial statement to look at in order to determine what the company invests in is its latest 10Q form. This is a report of financial performance that's required by all publicly traded companies to disclose relevant information regarding their financials as a result of their business operations. Since REITs invest in real estate, whether physical properties or in this case loans, they have to disclose what they own that's generating income. According to their latest 10Q, which was issued back in September, 95% of what Arbor Realty invests in are bridge loans. Bridge loans are very short-term loans that companies use in order to meet a current obligation. So typically companies will take out a bridge loan in order to pay for a current obligation until the company can secure a much longer-term financing option. A bridge loan is typically no longer than 1 year, although it can be 2 sometimes, and can even be as short as 2 weeks in certain situations. Companies that issue bridge loans like Arbor Realty are able to charge their borrowers significantly high interest rates due to the limited amount of options a customer may have if they need a large sum of money for just a short period of time. This is obviously how Arbor Realty is able to generate the overwhelming majority of its income. In terms of what they offer financing to, going back to their 10Q, about 89% of their portfolio is in multifamily properties. Because they invest so heavily in just one type of property, this initially had me concerned. As the old saying goes, diversification is key when it comes to investing, and I typically like to see REITs invest in a wide range of different industries and not too heavily into just one. I tried to do some research on how multifamily complex investments do during all market and economic conditions, and I did find some information on some websites. However, it's important to keep in mind that pretty much all of this information was provided by companies who offer people the opportunity to invest in them, so this information is biased towards favoring multifamilies. But according to Realty Mogul, multifamily properties provided investors with an average return of 9.75% a year between 1992 and 2017. And this line chart by Arbor Crowd shows that during the 2008 financial crisis, apartment REITs performed much better and recovered faster than the real estate market as a whole, as well as the S&P 500. And I think it's just common sense that no matter the market conditions, people are still going to need a place to live. Other real estate sectors like office, lodging, experiential, and retail will all suffer much more than apartments and multifamilies during rough economic times. But Arbor Realty's continued success, I believe, depends heavily on one thing, which is the still growing demand for multifamily duplexes. Because of a nationwide housing shortage, this has really revved up the demand for more housing in a lot of different markets in the US, and this graph shows that over the years, the number of multifamily homes has continued to go up. But if you notice a couple years after the 2008 financial crisis, construction on multifamilies dropped pretty significantly. Since Arbor Realty collects around 90% of their income from these types of loans, if the economy were to go through another recession like 2008, this company could really struggle during that time. And if we look at how this company did around the financial crisis, we can see this company took a massive nosedive during that period. In trying to figure out what happened and if it's likely this could happen again, I decided to comb through more of their old financial statements to figure out if the company was using a different strategy back then that caused them a lot of hardship during this time. According to this 10Q from 2007, back then, bridge loans only made up about 52% of their portfolio compared to over 90% today. Additionally, Arbor Realty does offer a lot of other loan programs according to their website, including private label, CMBSs, government-sponsored enterprise products, single-family rental loans, among others. But since these other programs are so minuscule when compared to their bridge loans, it's really not worth taking too deep of a dive into them in my opinion. So in conclusion, based upon what we've looked at, what does the future hold for Arbor Realty? In my personal opinion, I think as long as the demand for multifamily duplexes keeps increasing, and as long as we aren't greeted with another recession, and also considering their rising adjusted funds from operations, they appear to be going in a positive direction. I think what Arbor has going on though with their bridge loans is a pretty good strategy. They're short term, so they're less risky, and people who borrow from them are less likely to default because the whole reason they're taking a bridge loan out in the first place is because they intend to borrow more money for a longer period of time. Borrowers would have to be extremely confident in their ability to pay back their loan if they're taking out a bridge loan in the first place. If the duplex sector begins to struggle, I'm sure management will reallocate their bridge loans into other areas. And if we were to go into another recession, I think Arbor is in a better position than they were back in 2008. But be sure to do your own research and due diligence before making a decision and initiating a position in them. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below, and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.